If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. What happens when one of the world's most stable economies suddenly hits a wall? That's the question facing Norway as we examine the numbers from Q2 2025. For years, Norway's oil wealth fueled high living standards and robust social safety nets, making it a model of economic prudence. But this year, the story has changed dramatically. The economy, once a picture of strength, has cooled rapidly, catching analysts and citizens off guard. The challenge now is not managing abundance, but navigating a global environment that's become unpredictable, alongside domestic pressures that have quietly built up. We'll break down the 5 main pain points of Norway's slowdown, look at the impact on key sectors, and explore what's driving this downturn. The goal to understand the challenges and opportunities ahead as Norway faces an economic chill no one saw coming. To understand Norway's current predicament, we must examine 5 key factors. First, the nation's gross domestic product has contracted. After years of reliable growth, this reversal is a jarring signal. It means less economic activity and fewer services. A clear sign the powerful economic engine that once drove Norway forward is now losing steam. Second, unemployment is rising, ending a long period of job market stability. Job losses are becoming more frequent in key sectors like construction and retail. This isn't just a statistic, it translates directly into real hardship for families as household incomes shrink and financial anxiety grows. Third, Norgesbank's interest rate hikes, a necessary tool to fight inflation, have made borrowing more expensive. The cost of mortgages and business loans has soared. This financial tightening squeezes household budgets and stifles business investment, adding another layer of pressure onto the slowing economy. Fourth, inflation remains stubbornly high, creating a painful paradox. Even as the economy slows, the cost of living continues to climb. Norwegians are paying more for essentials like food and energy, and as prices rise, the real value of their hard-earned money steadily erodes, diminishing their purchasing power. Finally, there's the legacy of high debt. An era of low interest rates encouraged households and corporations to borrow heavily. Now that rates are up, servicing that debt has become a significant burden. These larger payments are eating into already strained budgets, reducing spending and making the entire economy more vulnerable. These 5 factors are not independent. They are combining to create a vicious cycle where each pain point feeds the next, amplifying the slowdown. This makes recovery far more challenging. The critical question is how to break this dangerous, self-reinforcing loop. Let's look closer at the numbers. Norway's mainland GDP shrank by 0.5% in Q2 2025, a sharp reversal driven by falling household spending and cautious business investment. Unemployment climbed to 4.2%, up from 3.5% a year ago, with sectors like construction and retail hit hardest. Norgesbank's policy rate stands at 4.75%, the highest in over a decade, pushing up mortgage payments and discouraging new business projects. Inflation hovers around 4%, still double the central bank's target, eroding wages and savings. Meanwhile, household debt exceeds 200% of disposable income, amplifying the pain of higher rates. The result: families are squeezed by rising costs and debt payments while businesses pull back on hiring and investment. These numbers paint a clear picture. Norway's economic chill is real, and it's biting deep. But how is this playing out across the economy? Let's begin with construction. Not long ago, this sector was a symbol of Norway's economic vitality. Now, it's in a sharp slump. The primary culprit is the surge in interest rates, pushing mortgage costs to prohibitive levels. This has stalled new housing projects and left developers struggling to secure financing from cautious lenders, sending shockwaves through the supply chain. The retail sector is also feeling the squeeze. Households are grappling with higher living costs and larger mortgage payments, forcing a pullback in discretionary spending. Consumer confidence has plummeted. In response, retailers are reducing hours, laying off staff, and in some cases closing their doors permanently, leaving visible gaps on once bustling high streets. The energy sector, especially oil and gas, remains a relative bright spot, providing a crucial buffer. However, its momentum is slowing. Global prices have stabilized from their recent peaks, and demand from key European partners has softened. While still profitable, the sector's slowing growth means it can no longer single-handedly propel the economy forward. Even Norway's dynamic tech scene, once fueled by cheap credit, is now facing a funding drought. Venture capital has become scarce as investors pivot to safer assets. This has slammed the brakes on innovation, forcing startups to abandon growth plans, cut costs, and reduce their workforce. The ecosystem is now focused on conservation, not expansion. Each sector tells the same story. The era of easy money is over, and the adjustment is painful. The slowdown is broad-based, affecting everything from construction cranes to retail counters to innovation hubs. Even Norway's substantial energy cushion isn't enough to offset the drag elsewhere. The entire system is under pressure, so what are the fundamental forces driving this downturn? Let's unravel the causes. The main culprit is policy Norgesbank's aggressive rate hikes to fight post-pandemic inflation. The medicine worked, perhaps too well, making borrowing costlier and cooling both consumer spending and business investment. Global headwinds have added to the pain. As Europe's economy slows, demand for Norwegian exports, beyond oil and gas, has weakened, hitting everything from seafood to tourism. High household debt has amplified the impact of rising rates, leaving families with less to spend as more income goes to loan payments. Finally, sentiment has shifted. As news worsened, Norwegians started saving more and spending less, deepening the slowdown. This feedback loop, where fear of recession helps create one, is now in full swing. Norway's downturn is a product of both policy and psychology, magnified by global trends and domestic vulnerabilities. So what can be done? With the economy at a delicate crossroads, Norgesbank's next monetary policy decision is crucial. After a period of high interest rates, inflation is finally easing, giving the central bank potential room to begin cutting its policy rate. This would lower borrowing costs for households and businesses, encouraging the spending and investment needed to restart growth. Simultaneously, the government can act, backed by its massive sovereign wealth fund, which provides extraordinary flexibility. This allows it to deploy targeted fiscal stimulus without accumulating risky debt. This could include temporary tax cuts for lower-income families to immediately boost their spending power, or accelerated investment in green infrastructure, creating jobs today while building for the future. A full recovery also requires active labor market policies, focusing on retraining and upskilling the workforce. These programs are vital to help workers transition from shrinking sectors like construction into high-demand growth areas like green energy or digital services. Enhanced unemployment benefits provide a crucial safety net, cushioning households and supporting consumer demand. To protect future growth, policymakers can also support the tech sector with loan guarantees or co-investment funds, helping ensure promising startups and innovations survive the economic downturn. For all these measures, the key is a delicate balance. They must stimulate growth and confidence without reigniting the inflation they worked so hard to bring down. This means targeting support to the industries and households where it will have the greatest effect. Norway's immense financial strength gives it a range of policy options that few other countries possess. The challenge is to deploy these powerful tools wisely and in coordination, restoring confidence and setting the stage for a sustainable long-term recovery. Norway's slowdown is real, but so is its resilience. The sovereign wealth fund gives policymakers room to maneuver, no need for austerity or new debt. The central bank and government must balance stimulus with caution, targeting support for households, businesses, and future growth sectors. This is also a chance to accelerate reforms, diversifying beyond energy and investing in green and digital innovation. Norway's story is a reminder. Even the strongest economies face shocks, but with smart policy and social cohesion, recovery is within reach. The coming months will test Norway's resolve and policymaking skill. But with its unique strengths, Norway is well positioned to weather the chill and return to sustainable growth. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.